Welcome back. The 30-year Treasury leading the fixed income rally following a strong auction. For more details, our Brian Luke joins us on set with the latest. Brian.
Yeah, Mark, we had a really strong auction. When you look at the results here, the 30-year rallying over 2 points, about 2.25 points on the day. I want to show you some of the details on this, but what it turns out to be is a very volatile time for these 30-year auctions. We see a lot of tails, what they call them in the market, when the yields jump about 8 basis points between that. Now, what we saw from this was a $12 billion auction. It was a 2.92 bid to cover mark. That was very interesting because that's the third highest bid to cover we've seen in this 35 auctions going back to 1994. And finally, the yield offered was 4.24%. Again, that's the third cheapest cost of funding for the auction and for the U.S. Treasury. They're getting a great deal on this. There's a lot of things that people are talking about in terms of being able to offer a record amount of issuance and a record amount of supply, but getting it done at a very cheap level.
Right. A strong rally today, but where do we go from here?
That's the real question, is you have to focus on a lot of the questions about where we're going to go from here. When you look at the analysis about after the bonds are auctioned, the yield curve tends to move down, and I'll show that to you a little bit later in the show, but essentially after the auction, the 30-year bond and between the 30-year and the 10-year moves down significantly, and that's what we're looking at, and that's where Barclays Capital is actually saying the opposite. They thought that they need to actually have the yield curve steepen more for great demand, but that's not the case. That's what we saw today, strong demand.
Brian Luke covering Treasuries, and Brian's going to stay with us as we talk to our next guest. Treasuries may be rallying today, but our next guest says it won't last. Dan Fuss is the vice chairman of Loomis Sayles, which manages about $64 billion worth of fixed income assets. He's the co-manager of the Loomis Sayles Bond Fund, which has gained 26.5% year to date, outperforming more than 91% of its peers. Mr. Fuss, good to see you again. Welcome back.
Well, thanks. Good to be here.
What's going on in the Treasury market today, and why do you think that this rally's not going to last?
First place, I just heard what's going on from Brian.
Yeah.
So thank you. Apparently the auction went very well, and they do tend to set up for the long auction, so that is good news that it did go well. Eventually, in my guess about the future is that the Treasury offerings overpower the market as we go forward. There's more and more and more and more coming. The peak rate of increase is behind us, thank goodness. But they'll be just financing more and more and more and more of the Treasury deficit. The Treasury borrowing requirement, looking forward on the most conservative basis, is formidable. Where are you going to find the people to buy all these bonds? Eventually, it's going to be the three of us right here, plus our friends. We've got to bring the financing back to the U.S. It is very encouraging to see how well the long bond went today.
Dan, let me ask you, when you talk about your great performance on the year, you're certainly not buying Treasury bonds because they're underwater on the year, negative 3% or more, depending on which index you follow. Probably buying a lot of corporate bonds. Is that what you're positioning your portfolio at right now?
Exactly. That tends to be our strong point. Now, a large part of the performance this year is literally same bonds, new prices. We owned them on January 1.
So you've been able to hold through that downturn all the way through and capture all the rally. The question is now, where do we go? We've seen some corporate bond spreads rally down to where not even just pre-Lehman levels, but pre-Bear Stearns levels. Right. Are they still of value at this point? That's what a lot of investors want to know. Where can we get the incremental yield if Treasuries aren't getting us there?
You got a problem. The Treasury spreads, the credit trends are better than given credit for, but the spreads between the very high-quality corporates and Treasuries are now, you don't have anything left to gain on those. So you're trapped with following the Treasury market, and that's not too good.
Dan, the market for Fannie, Freddie, and Federal Home Loan Bank debt, that's the stuff that's almost like Treasuries. That's been shrinking pretty fast. Is that going to continue?
Oh, yeah, they're gradually going away, so to speak, but the spread has gotten down to minuscule levels, so there's really nothing extra in those bonds right now.
What are the implications of that?
Well, number one implication is there's a push for yield, which I understand. Secondly, some of that demand does slop over into corporates, high-quality corporates. But overall, more the corporate market, and certainly the entire agency market, has now become captive of the Treasury market, so that when you're analyzing high-quality corporates or agencies, you really have to make your guesses on the Treasury market.
So there's really no place to find the yield. You feel that the corporates are actually at fair value, if not a little bit overvalued. The Treasuries, with all the supply, you seem a little bearish on that. The question is, where can we capture yield, and how, as a bond portfolio manager, do you do that?
Well, the first place is you start to cut your duration.
Right.
When things become pure market risk, and our guess about the future, my own guess about the future, is eventually the heavy Treasury borrowing requirement starts to drive rates up. Is that going to be next month, next year? I don't know, but there's nothing left, no value left in waiting. And markets have a ferocious tendency to get there before you think they should.
Dan Fuss of Loomis Sayles, Vice Chairman, talking to us today about Treasuries and bonds. Always good to talk to you. Thank you. And Brian Luke, covering Treasuries First today. Brian, thank you very much.